Welcome back to the InvestTalk Classroom. I'm Justin Klein.
I'm Luke Guerrero.
And today we're going to talk about mutual funds and ETFs. And this is a very common way for people to get invested into the markets and get broad diversification. And these are important to understand because a lot of people say, are mutual funds safe? Are ETFs safe? And really, that's all dependent on what they're owning. There can be funds across a different suite of assets, right? You can have bond funds, you can have commodity funds, you can have stock funds, equity funds, foreign equities. So they run the gamut. You can have funds that have a mix of assets. And so it's very important to, once again, we always go back to know what you own. And so, but mutual funds have been around for a long time, since the 70s, even probably before that, 60s, yeah. So, but ETFs, they're relatively new, launched in the 90s. So that's relatively new in the market history. So Luke, why don't you talk a little bit about the differences between the two? I know you used to run both of them.
I did. And, it's like you said, it's very topical nowadays because, historically, I think people thought the difference between mutual funds was primarily mutual funds tended to be more active and ETFs tended to track passive indices. Mm-hmm. But the benefits of the ETF structure has caused a lot of companies to shift towards active ETFs, mm-hmm. right? Where they create their own indices internally that they are rebalancing towards daily instead of the S&P 500 or the Russell 3000 or something like that, right? So essentially what you have nowadays is you have two similar vehicles, mutual funds and ETFs, that just have kind of different benefits and different structures, right? Mm-hmm. So the biggest difference that I can think about in terms of mutual funds versus ETFs is how they're traded, right? So if you're buying a mutual fund, you buy it on today, for example, and you get the net asset value, which is the sum value of everything it holds at the end of the day. That's your price.
Very simple.
ETFs is traded on market. It's traded intraday, meaning that hypothetically it should be more price efficient throughout the day, right? So that's kind of one of the biggest differences between these two vehicles.
And ETFs tend to be more tax efficient than their mutual fund brethren because of kind of how the machinations, shall we say, of how they are traded and how they're run, and so I think that's a big difference that you have to consider, and you can actually short an ETF, right? I think that's something most people don't realize is that you can go short a particular ETF where you can't go short a mutual fund.
Yeah. And, the tax efficiency is really related to essentially the mechanics of how you are buying and selling it, right? Mm-hmm. So if you're buying a mutual fund share, you're giving cash to the manager of that mutual fund, mm-hmm. generally speaking. And there's going to be turnover on the market, which is going to induce things that are at gains or losses to be sold. And that's going to hit the end investor, all end investors, regardless of who's buying or who's selling on any given day. An ETF is a little different. You're giving your cash to an AP, an authorized purchaser. And instead of it going directly to the manager, generally you're going to give it to the AP who gives them a basket of securities. And because of that, there's less turnover. You're not selling things that are at a gain or selling things that are at a loss. So really the benefit in tax efficiency is typically the person who's affected when something is bought or sold is only the person who's buying or selling.
Yeah. And I think one part of the fund universe that most people don't pay enough attention to are really the costs, because they don't really see it, right? There's no line item that says this fund costs you X, right? There's in the prospectus, they'll say, every $1,000, this will cost this much per year, but that's pretty much it. Most people aren't reading that prospectus, where what basically happens, and you can dig a little deeper into this, is basically at the end of each day, they charge some sort of a percentage, right? And adds up in total for the year for that total basis point charge. So it's one of those things where you don't see that line item, but you are getting charged. There's a cost there to owning these funds.
Yeah, there's a cost, there's an explicit cost, which mm-hmm. like you said, is in a prospectus. And certainly a lot of people don't deep dive into documents on mutual funds, though maybe they should, because again, the thing we always tell people is know what you own. Yep. But there's also secondary costs, right? There's implicit costs. And that's what we were talking about before. What's the cost of turnover? Mm-hmm. You're paying broker's commissions every time you're transacting. What is the cost of how aggressively they trade? Mm-hmm. Because some mutual funds are more passive, or some ETFs are more passive in the way they trade. Mm-hmm. Some are more active. They're willing to cross spreads. They incur wider spreads, mm-hmm. and that goes back on investors. Mm-hmm. So ETFs tend to be a little bit more efficient in that because of the way they use those APs, like we mentioned, as opposed to mutual funds. But all these costs add up over time.
Yeah, there's explicit and implicit costs, and what you talked about a lot about those implicit costs. The explicit implicit costs are still overlooked typically as well, but they're a
Yeah.
little bit easier to see.
But the implicit costs can outweigh the explicit costs.
Absolutely. So make sure that you're understanding, once again, what you own and doing a deep dive into each of these funds. If you're owning them or looking to own them, understand the tax efficiency and the underlying assets that you're getting exposed to. And no ETF is completely safe. There are risks to everything, just like there are with all assets. Thanks for tuning in to this episode of InvestTalk Classroom. Catch you next time.